And if you have, say, just 20% of EVs manufactured have these Samsung batteries, then the amount of silver that requires is equal to the total supply for a whole year. So, this is not going to happen at these prices. You see what I mean? So, what's happening basically is that everybody who needs silver as part of a production process is finding that, my God, we'd better grab what we can. And of course, this has created a crisis in the derivatives markets. At the same time, there has been a sort of modest increase in ETF ownership. And so this has eaten into the free float in London and also in COMEX. I mean, the deliveries coming out of COMEX are quite remarkable. Something like 15,000 tons this year has been stood for delivery on COMEX. Now, we can't say for certain that all that is industry using COMEX as the largest silver mine in the world, but I can be pretty certain that there is a lot of industrial demand because if you're ramping up production, you go along to the refiners, you say, when can I expect some silver? I don't care what price. The refiner will say back of the queue. So they go to COMEX and they go to London, they go to the markets, they're cleaning out the markets, and that's going to continue. It's bound to continue. And it's creating the most massive squeeze on the derivative system. It's not just in silver, it's also in platinum. I mean, platinum has actually moved faster in the last year, I think, than silver has. Again, that got very, very oversold. So I think the outlook for silver and platinum and also industrial metals generally in 2026 is going to be for higher prices. And I think in silver's case, this squeeze, I think, has the potential to go a lot further. I'm not going to say how much further, but you can be sure that we're going to see far higher silver prices in 2026.
We are witnessing the end of the fiat currency era. The biggest credit bubble in history will burst in 2026. Silver demand from Samsung batteries alone could consume an entire year's supply. Gold is front-running the dollar's collapse toward infinity. Central banks know this. Get out of credit into real money now. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
We just know that when things cut up rough for a fiat currency, you just got to get out of that and get into gold. So, gold rising. I mean, we've got it today at 4,489. I mean, this is a new record. When this goes out, I don't know what it'll be, but could even be a bit higher. It's just literally broken out into new high ground as we speak. So this is something which I wouldn't be surprised by the year end. We might see even $5,000. I don't know, but anyway, I'm not forecasting that. The point about it is that gold is front running. It is discounting, if you like, somewhat the problems that the dollar is facing. China has suppressed the price of silver for industrial purposes for a considerable period of time.
Yep.
I detected this when I went to New York back in, I was speaking at a conference, I think it was probably about 2010, something like that. And there were a bunch of silver miners, exploration companies and all the rest of it, exhibiting at this conference. And I asked all of them, how do you turn your silver into cash? Because you've got to pay wages, you've got to pay energy bills and all the rest of it. And it was quite simple. I mean, basically, the man from Glencore or Trafigura would come along and assess its value. They would tell the bank, which I believe was JP Morgan, and their account would be credited at JP Morgan. The doré would be shipped off for refining to, guess where? China. So you had this sort of thing whereby all the silver, particularly from these marginal producers, was going up to China. And it's been doing that for ages and ages and ages. So China had huge, great hidden stocks, still has. And the way in which it was controlling the price was, with JP Morgan and others, it was managing the paper price, if you like, the derivatives through the derivatives. And at the same time, more lately, as demand has exceeded supply, I mean, looking at the Silver Institute's numbers, they have been the marginal supplier, if you like, into the global market in order to suppress the price. Now, the reason the price has taken off basically is that China stopped doing it. And this is partly, I think, sort of an extension of the rare earths policy. That there's a realization in China that, okay, they've built up the ability to mine a lot of silver, process a lot of silver, import doré from everywhere, also import other ores, which of course have silver content, extract the silver from there, and so on and so forth. They've realized that they've got to hang on to this stuff. Now, why is this? Obviously, photovoltaics, huge, huge, great market. But I think one thing that's excited industrialists, as far as silver is concerned, is the new Samsung electric vehicle battery. Now, what this means is that instead of around about 25, 30 grams going into conventional lithium-ion batteries and associated equipment, you now have about 1 kilogram of silver going into each car. And let's just take the concept a little bit further. We are looking towards the end of the fiat currency era.
Yeah.
Now, this is an extremely important point, because unless some action is taken by the issuers of the fiat currencies to link its value to the complete commodity complex, which is represented by gold, then their value goes down to zero.
Yep.
Which, put another way, means the relationship between gold and the dollar would price gold at infinity. That is the logical consequence, if you like, of accepting the statement that we're coming to the end of the fiat currency era.
Yeah.
There are every sign that this is the case. And the thing that's fascinating is if you look at the end of other fiat currency eras where they are decently documented, and the best documented was the collapse of the Reichsmark following the First World War. We are at the stage, I think, where the collapse of the dollar in 2026 could well begin to accelerate. That's what gold is telling us. That's what the bond markets are beginning to tell us. I mean, the interesting thing about bond markets is that the ones which are ahead of the game and running into new high ground in terms of yield are Japan, France, and Germany. So we're looking at some pretty major G7 players are getting into this debt trap already. And when you look at the finances of Britain, some of the others in the European Union, but I've said the two most important ones, France and Germany, you look at that sort of overall situation, you can see that. I mean, put Britain in there, and wow, this is this is a real currency crisis in terms of purchasing power. Because the way this is reflected will be a huge surprise for everybody. And that is that inflation, consumer prices will be rising strongly.
Yes.
Certainly in the second half of 2026. Nobody expects this at the moment. They're rather myopically looking at, the next interest rate cut. But of course, all this is fueling, it's fueling sauce for the goose. I mean, basically, what we're going to get, I think, is the consequences of the collapsing dollar and the other currencies that will go with it, and they will go with it. We have an equity bubble. Now, when you're talking equity bubbles, don't confuse the issue by thinking in terms of fundamentals and momentum and all the rest of it. That's just a symptom, if you like, of what's going on. What we have is a bubble, and it is the biggest bubble in history by miles. I mean, recorded history. I mean, I can't talk about Babylonian stock markets or anything like that. This is the biggest in history. It is bigger than 1929. You know, the Roaring Twenties running up to 1920.
Wow.
It is bigger than that. Furthermore, back in 1929, you had the Smoot-Hawley Tariff Act, which was beginning to be discussed in Congress, came into law in about April 1930. What have we got today? We've got the biggest credit bubble in history, and at the same time, we've got Trump's beautiful tariffs. Now, we don't know how they'll settle down. I mean, he keeps on changing the numbers at will. So, but it does create an additional level of uncertainty, as well as raising costs for US consumers. So the situation is, by any measure, very, very unstable. Now, let us think through what's going to happen in 2026. The bubble will burst. We don't know when, we never know until after it's actually burst. My view, however, is that it's not far off. Now, I'm not going to define how not far off is, but, you know, if you told me that, you know, it's going to burst literally on the day after the New Year's holiday, I wouldn't disagree with it. It may sort of continue on for, you know, a few weeks after that, maybe a month, two, I don't know. But this is very, very close, and it's very, very dangerous. When the bubble bursts, then obviously you're going to get cascading selling of equities. The consequence of that is going back to the banks, who basically created a lot of bank credit to support these assets, is that they will turn sellers in the market as well, basically to secure the value of their loans, because you know, there's no way they're going to sit in their hands if you get a really dicey market. So you can see that we have got the potential for a fairly rapid collapse in equity values. One thing that might trigger it, in fact, I'm pretty certain that this is what will trigger the timing, is what's going on in bond markets. Now, I've described how gold is front-running, if you like, dollar weakness in 2026. But if you buy US Treasuries, then you're going to look at this and you're going to think maybe from a completely different angle. The risk in 2026 is that I might not get the value of my investment in a bond back. If you're talking about bullion, then in the banking world, nobody really wants bullion, because what is a bank? A bank basically is a dealer in credit. And that's why they would rather deal in derivatives. So if you're going to cover a position, it means that these bullion banks, for them, is to buy some sort of derivative to give them the synthetic exposure, if you like, to gold. Now, they can run a positive position synthetically in London and a negative position synthetically on COMEX, which, of course, is what happens generally. The fact that they're not long is interesting because they've also got to cover, and this is an important point, they've also got to cover the unallocated gold accounts that they offer their customers. Now, an unallocated gold account basically is an account where the bank doesn't hold the gold to back up the account. In terms of banking, what you might do is you might have a little bit of gold, if you like, just because some idiot might want to cash in his unallocated account. So, you know, there's probably a little bit of stock, if you like, in that sense. But the bulk of the risk coverage in this, of course, will be synthetic through, you know, forward transactions, through options on gold, maybe probably out of the money, as it were. So, you know, it sort of caps the losses if the gold price, unfortunately, rises, that sort of thing.